Welcome to Every Dollar Counts with Josh and Jay, a shot of truth serum for your investment and insurance questions. I'm Josh Null, the owner of Gulf Coast Financial Advisors, and I'm joined by my co-host, Mr. Jay Stubbs, the director of the Gulf Coast for Concourse Financial Group. We are brought to you on the Gulf Coast Financial Advisors podcast network. Well, today, listeners, we are going to talk about life insurance and retirement planning, what is commonly referred in our industry as LIRP, L-I-R-P. Living longer, having more years in retirement, potentially rising taxes, uncertainty in the market. All these things have investors searching for more tax-efficient options to help them diversify their income stream in retirement. So I want you to join us today. We're going to hear about a particular concept that may help you, not outlive your money. That's really kind of the goal. But before we dive into this, let's have our friends from Sloth Racer kick us off. Quick housekeeping for compliance. Jay Stubbs and Concourse Financial Group are not affiliated with Prime Capital Investment Advisors, Qualified Plan Advisors, or Gulf Coast Financial Advisors. And me, Josh Null, is not affiliated with Concourse Financial Group. So Jay, buddy, how are you today, my friend?
Josh, I'm doing well. Good to be with you here in Deep Fried Studios, Johnny Gwynn and company. Down here, it's always good to get in downtown Mobile and get a little bit of blood flowing, and being here in studio with you is the way to do that.
Well, Jay, I appreciate that. Same here. I've really enjoyed this. I miss being in here. You and I both got a little bit busy, but here we're back and we're full force ahead. So, Jay, as we dive into this, we're going to start where I think most listeners, or a lot of listeners, would be at right now is, okay, life insurance and retirement planning. I get the term, and I hear you saying LIRP, but what is it?
Well, LIRP is an acronym. So we say LIRP, Life Insurance Retirement Plan. But before I get into the details of LIRP and how it works, let me first kind of explain why somebody listening would want to consider it as an option for one of their strategies. So Josh, your client's retirement income is likely going to come from a variety of sources. They'll have Social Security, knock on wood. They'll have IRA contributions. They'll have pensions, perhaps, personal savings and investments that you've worked with them to grow over time. And as life expectancy grows and people start living longer and retirement becomes theoretically longer, especially if they don't have any health issues, more and more retirees are finding that they have some of the traditional ways to save. They've maybe maxed them out, or they may not have enough. They may not want to have enough money sitting in the accounts. So another way to look at it is just to find another asset class and position some money in another asset class. Well, which one makes more sense, or which of the asset classes make sense? We want to look at it from a tax perspective. So if we start thinking about ways that we're going to draw income in retirement, you might have three different buckets. You're going to have that tax-deferred income bucket. That's the 401k plan. That's the IRA, the SEP, the Simples, and everything you're making contributions into, getting tax-deferred growth, and then you pull money out at your tax rates down the road. Then you're going to have another bucket, which is the taxable income. That's the non-qualified accounts. That's the, hey, I want to put money in this mutual fund, this stock, this particular exchange-traded fund, this asset. I want to put money there. I want to hopefully let it grow and manage it over time, and that's going to be part of my income from my retirement portfolio. So we have tax-deferred, then we have taxable, then we look at tax advantaged. Now, our good friend life insurance and Roth 401ks and Roth IRAs are the tax advantage versions. We can put money in those, they grow tax-free, and they come out income tax-free under current tax law. A cash value life insurance policy is included in that tax advantage bucket of money that you're going to advise your retirees to take money from. So ultimately, if we have a cash value policy and we start thinking about utilizing it, then we look at the concept of LIRP. LIRP is the life insurance retirement plan, and I'm going to boil it down to really simple. How much money, or I want to sock away a certain amount of money, I want to put it in and let that grow tax-free, and at some point I want to start a distribution or an income stream from that asset.
Very good.
Does that make sense?
It makes
Now, that's just the kind of the foundation, lay of the land, LIRP. I'm putting money into something that's going to be tax advantage for growth and tax advantage for income at some point in the future.
And this is a concept that's been in place for decades.
Decades and decades. So when you think about life insurance, there's term. Term doesn't have cash value. A lot of people own term for specific risks, family and business risk. Then there's cash value policies such as whole life, universal life, variable universal life, which is tied to stock market performance, and indexed universal life, which is maybe tied to a stock market index. There's lots of different cash value policies out there. You can use the LIRP strategy with any of them.
Very good. And Jay, let me ask you this. You mentioned something in the different buckets. You were talking about tax advantage. You mentioned Roth IRAs, Roth 401ks. Give us an idea of why would someone, is there any time period where someone would like to have the advantage of a Roth IRA where they put the money in after tax, like you said, it grows tax-free, take it out in retirement without any additional taxes owed on it. But some people don't qualify for that. Can you touch on that?
Yeah. So, the first drawback to Roth is you can only put so much per year into your contribution, and that depends on your age. 55, I think, is the magic number where you can throw in an additional $1,000 annually. But then the Roth rules state that if you are if you make household income of roughly $200,000 or more, I think the exact number for single is 125, and for married it's 198. Most people you deal with are married, so if they're making $200,000 a year or more, then they are phased out from being able to do a traditional Roth contribution. They may be saying, well, golly, I want that tax deferred or tax-free growth and tax-free distribution of income. How do I get that? And that's when you would talk to them about the LIRP concept.
Right. And why would you think somebody be interested in a tax-free bucket in retirement? And what I mean is looking at historical income tax rates.
Well, we have to pay money on the income we draw at all phases of our life. So as I stated earlier, you're going to have the taxable bucket, you're going to have the tax deferred bucket. When you draw money from those two buckets, you're paying income tax annually on whatever you pull out, whether it's capital gain tax rate or income tax rate. If I pull money from a tax advantaged strategy, that's a non-reportable event to the IRS. So if I have a bucket of money that can pay me $20,000 a year on top of my Social Security income and my other income, maybe $50,000 a year or even $100,000, we've designed plans that can get an additional $100,000. Those types of plans come into the household income tax free, non-reportable events. And as long as the policy, the underlying policy, or as the asset stays in force, remember, the policy has to stay in place in order for it to work, then it's a non-reportable event and it's an income tax-free event to that client.
Well, that brings up a good point, Jay, because, again, we're going to stay in the tax advantage bucket, and specifically with Roth IRAs. If you have a Roth IRA and you carry that into retirement and you die, whatever is left in the balance of that Roth is basically what your beneficiaries are going to receive, correct?
That's exactly right. Now, every plan, every qualified plan, every 401k, every IRA, everything that you have with respect to that type of planning has a beneficiary designation. I take this time to remind people, check your beneficiary designations. Make sure they are the person or people you want them to be. But when you pass away with a balance inside of those types of plans, it's going to be more often than not your spouse or your children, or perhaps maybe even a trust or an estate. So without going into too much detail, the only thing that they get is the balance at the date of death. However, in a LIRP strategy, remember, it's life insurance as the foundation of the plan. I'm going to be giving them a larger bucket of money at death. So if I make contributions into this strategy and I predecease taking the income from it, so if I'm 44 in February, Josh, if I have a 20-year plan where I'm going to put X amount of dollars into the plan from age 44 to 64, and at age 65, I'm going to draw an income from it. But whoops, something happens to me and I pass away predeceasing my plan and die at age 60, my beneficiary or beneficiaries will receive the death benefit component of the LIRP strategy that I put in place 15 years ago at age 44. They're going to receive that income tax free. We like to say that is the self-completing feature of the LIRP strategy. And it's a very powerful strategy, and it can complement your overall financial plan when you have that death benefit component. It can maybe even replace some insurance you already have, or it can be added to an existing insurance plan.
Perfect. You mentioned a specific age there, Jay. I think you said 44. Is there an ideal time for someone to look at implementing this strategy?
Yeah, we've done LIRP strategies for clients in their early 30s. You want to do it when the cash flow makes sense. Obviously, you want to sit down with somebody like yourself and get a good financial plan together. But if they're making contributions to a qualified plan, they're making contributions to an IRA, or they've made too much money to do the Roth IRA concept, they might want to consider this strategy. They're working, they've got good cash flow, they've got predictable income. I like like to say that predictable income. They're in a good, maybe W-2 salaried position. They've got an opportunity for growth. They're well entrenched with the company. They're maybe a business owner, and they want to take this as an opportunity to reward themselves for building a good business structure. You can even use a LIRP strategy as a business owner for key employees. But at the end of the day, we see a lot of LIRP strategies go in for ages 30 to 50, sometimes even age 55. And again, you design a plan on a time frame that you want that fits your lifestyle and your income. So it can be 5 years, 10 years, 15, even 20. You then also decide what the contribution amount to the plan is going to be. We've seen people do it for as little as $500 a month or $6,000 a year. And we've worked on plans where people have done $20,000 a year for 10 years or even $50,000 a year for 10 years. It just depends on their personal planning,
right,
what other aspects of tax advantage, tax deferred plans you've set up for them. And then this complements on top of that.
Last question for you, Jay. So how would someone go about it if they're interested in doing a LIRP strategy? What's the next step?
Well, they need to have a conversation with an advisor like you. They need to make sure that they're in the number one thing. This is a life policy. They need to make sure they're insurable. So somebody who's just had a significant health event, while we still can look at that and maybe put you through an informal underwriting process, you still have to be able to qualify to do a LIRP strategy. So I like to remind people, if you're on any prescription medications, if you've had any significant health events in the last several years, make sure you speak with a specialist, somebody like you, Josh, or me, and at the table with them or over the phone or through a Zoom call. If they like this, they say, hey, well, I've had this health event come up. Can you see if I'm still going to be able to qualify? Because at the end of the day, the company, the underlying company you're doing the strategy with, they're on the hook for the death benefit. They need to make sure that they're not getting into a bad deal with the insured. But once you get through the approval process and it's fairly painless. You might have to do a series of medical questions. You might have to do a what we call a paramed exam. But once that's done, you then get to design your plan with the contribution amount and the length of time you want to make the plan work.
Very good. All right, so listeners, again, we were talking about life insurance and retirement planning, what us nerds in the industry call LIRP, because we can never shy away from giving something an acronym at all. And you've heard what it does, how it works, how you go about getting it, some of the reasons why you would look at doing it for the tax advantages and the things of that nature. So Jay, any final thoughts on that before I wrap up the show?
Well, at the age of 44, I'm still a couple of decades away.
Such a puppy.
You and I are both a couple of decades away, with all intents and purposes, from drawing on any kind of retirement assets that we're working and building towards. But to pinpoint the ways to maximize our retirement income are things that you and I are going to be interested in, to have that good retirement lifestyle with our spouses, with our children, with our potential grandchildren, to be able to do the things that we want to do in a very tax efficient, possibly even tax-free manner. And who knows what the tax income brackets and the capital gains taxes are going to look like 20 and 30 years from now. But at the rate that our government is currently spending money, I would have to think that they're either going to maintain today's tax rates or be even higher down the road. So having a tax advantage bucket where we can draw money from that and not be a reportable event to the IRS will be very impactful to our overall retirement income strategy. Very
good. All right, so listeners, if you're interested in learning more about this topic, you can reach out to us. Call 251-327-2124, or you can visit my website at gulfcoastfa.com and set an appointment there on my Calendar app. While you're there, we would appreciate if you would share information. Check out the rest of our podcasts. We have all kinds of information. We've done, Jay, almost 50 shows now, so we've got a ton of information there on the podcast tab. Go ahead.
I was just going to say, we're getting to expert level on podcasting. Johnny Gwynn has kept us rolling on that. Deep Fried Studios, all the props.
One of the best decisions we made. So, and to all you independent and semi-independent advisors and agents out there listening and interested in the value that Jay Stubbs could bring to your practice, like he has with mine, you can find him at jstubbs.com. That's JAYSTUBBS.com. Tax-free is a subjective term. Interested parties should consult with their own tax professional to determine potential tax status. Prime Capital Investment Advisors, LLC, PCIA, and its associates do not render any legal, tax, or accounting advice, nor prepare any legal documents. Clients understand that his or her personal attorney should be solely responsible for the rendering of tax advice. When considering the purchase or use of a LIRP, your insurability and the need for a death benefit should be primary factors in the decision as to whether a LIRP is appropriate for your situation. All right, my friend, another show in the can. Many thanks to our producer, Johnny Gwynn, here in Deep Fried Studios. Many thanks to you, Jay Stubbs, my co-host. And as always, a huge shout out to all of you that have joined Jay and I on this journey. To those of you that are joining us now, Do me a favor, please subscribe on the Apple Podcast app or wherever you find your favorite podcasts. And while you're there, you would be doing us a huge favor if you would rate and review the show. It helps other listeners like you find us. Lastly, you like the show music? Go check out slothracerband.com. That's slothracerband.com. This has been Every Dollar Counts with Josh and Jay. Advisory services offered through Prime Capital Investment Advisors, LLC, PCIA, a federally registered investment advisor. PCIA, doing business as Prime Capital Wealth Management, PCWM, and Qualified Plan Advisors, QPA. Gulf Coast Financial Advisors is independent of Prime Capital Advisors. Information presented for educational purposes only, is not an offer or solicitation for the sale or purchase of any securities. All investments involve risk, and unless otherwise stated, be sure to consult a tax professional before implementing any tax or investment strategies.